Okay, welcome to the risk management postgraduate risk management session. Today we are planning to do some past papers and getting you ready for the examination. I think we covered the syllabus in almost 9 sessions, and then last week in person I was fortunate to meet you all and then do a revision of all the sections what we have already learned, and now it's time for me to actually indulge in some question and answer sessions. I would have preferred this to have in person, but because of this health restrictions, I think we are once again into online training. And one bit of advice where, since we are planning to do past papers, there's a similar pattern in most of the past papers, but questions are different. So it covers the entire syllabus, and each section of the risk management what we have indicated in your syllabus and what we have learned so far will be covered in these questions. And some are very direct questions, whereas others need a little bit of understanding. So my personal advice on actually facing an exam of this nature requires your concentration during the 3-hour period, and prior to that we have 8 questions in all, and you are required to answer 5. So each questions carry 20 marks. When you have a situation of that nature, you need to identify first 5 questions which you are going to answer. Then you need to manage your time, because you have 3 hours. 3 hours is 16 to 3 is 180 minutes. So 180 minutes you have to divide by 5, which is about 35 minutes per question. Or a little over that, it's about 45 minutes per question. So you need to really plan it in such a way, about 40 minutes a question. So you need to plan in such a way that you should not exceed that time quota given for a single question. My past experience with corrections, I find a lot of people first decide the questions quickly as possible, don't read what is being asked by the question, and then start writing. So the second advice I could give is, please read the questions not once, maybe 2-3 times until you understand the keywords there. Now we'll take for a question here. These are very direct questions, and question number 1. Risk management has become a responsibility of board of directors. Now risk management is our subject and board of directors is a keyword here. Now responsibility of, immediately it will come to your mind, this particular subject is now under the scrutiny of board of directors, so it is been given the highest status there. Key management personnel, all employees. So it's not only board of directors, the question talk about the key management. Key management is your corporate management, and employees to the bank is you and me. So if you are working for a bank, I think it is part of our responsibility. That's what the question says. So they're asking that describe the process of risk management. So though the original jargon of the question will give you a understanding that this is responsibility, the answer you are asked to supply here is about the process. Now, risk management process we have discussed over and over in all our earlier sessions. So once again, I can put you on the board the risk management process once again for you to remember. So you remember the process. I said first we said to manage risk, you need to identify the risk. So risk management process starts with identification. And we repeatedly said to manage risk, you need to be able to manage anything, you need to be able to measure. So second one is measurement. Then I said, once you identify, you know amount of risk what you are going to undertake, you need to respond. Now this stage, your response can be a positive one or a negative one. Generally, if the risk is high, we always talk about uh, risk management. Best way is to avoid certain risks. So this way you can accept or avoid. In banking terms, sometimes we say you can approve or you can decline. Once you accept, you just can't wait. Now you have accepted the risk. So you need to monitor. If the risk is still getting higher, you need to control. And then all the risks what we undertake need to be reported higher up. So we call it report. So now you can see our risk management process. Clearly, and so the first question, question number one, section number one out of that says describe the process of risk management. If you draw up this chart like this, you will get full marks. So you don't have to describe what are these, because this is a very direct question. A lot of people go into the details of what is risk identification. Risk identification, this is quite sufficient for this answer, but a lot of people go into various aspects of this and then further describe. It's good for knowledge, and I would like to read those comments also. But for this question, if with the time permitted, if you draw up this chart, what I draw on the board would be a sufficient answer for that. Then it says, second one, what components should consist of integrated risk management framework to manage different type of risk? Now you need to understand here, they are talking about two keywords. What components of integrated risk management? Now this is the risk management process. The second question is asking about integrated risk management framework, and on that framework they also ask another keyword is called risk types. So I generally expect you to understand two different things here. The first one is it's about what components consist of integrated risk management, and in that framework, what do you manage? So first, if you can decide on what type of risk and integrated risk management manages, it's good. I think if you remember correctly, we had a diagram for this again. The type of risk I used to draw these circles. And I used to this portion where all three circles goes, and first we said risk management manages different types of risk, and we insisted that we are a financial services organization. So the major risk is financial risk. And we drew up our balance sheet and explained to you under that financial risk, there are three other types. We call it credit, market, and liquidity. So major risk what we covered. Now with this we have covered three types of risk that a financial institution generally encounter. We also said that the risk of any businesses face is a strategic risk. That is to you plan yourself how to be a winner, how to stay in the market, be competitive enough for your competitors, and also since the financial is a service industry, be the best service bank so that you can remain in business for a long period. So these strategies include how you treat your competitors and how do you treat your customers. So it's a very important area in financial services because this is we consider as the only differentiator which you could have. Like if you have good strategies, you can take the market share from your competitors. You can take the customers out of competitors and create value for all your stakeholders. So strategic risk on the other side. You also talked about operational risk. Operational risk, we emphasize that with the invention of online banking, phone banking, ATMs, and different delivery channels, risk under this operational risk also has been enhanced in financial institutions, so it is a major one. We also talked about another risk called compliance risk. We discussed this issue in length when we went through our slides in the early introduction, because I said banks need to be supervised or overseen by the regulator, because we are dealing with customers' funds, and safeguarding customers' money is one of our prime duty, and it's a prudential task. Therefore, regulator time to time issue directions, um, issue various circulars, and we need to abide by those. Non-compliance or non-adherence to these circulars and directions will lead to compliance risk. Compliance risk it's a major risk, because if you are being little too naughty, not adhering to their regulations, you might even end up in getting your license cancelled. So compliance risk is the other area. So 4 major risk types are financial risk, operational risk, strategic risk, and compliance risk. And in between, we have these, I said, other important areas: technology, under which we discuss information risk. We insisted that cyber attacks, safeguarding your computer center, we talked about business continuity planning, disaster recovery, all this linked to information risk, because you need to safeguard your database from outside attackers or even from fraudulent activities of your own staff. So this is another major area. We also said legal. Legal risk arises from banks eternally have contracts with clients, contracts with employees, contracts with suppliers, and not adhering to those conditions that are set out in those contracts may lead those other counterparty to sue you. So we need to see that we study those contracts well and see our obligations are met with the legal risk. So we also talked about another called reputation risk. Banks run on the reputation. We talked about debt equity ratio of 9 to 1 in banks. In that type of situation of analyzing very high debt equity, people need to see that you keep a good reputation. On your confidence, the customer confidence is required to maintain that. When you have that kind of high debt equity, normal analysts would not like to place money in the bank, but your reputation and your subject to compliances will lead for people to believe that the safest place to place money is a bank, and therefore we thrive on. If you manage reputation and compliances, people will get that confidence, and if confidence erodes, it erodes faster, and we lose our business. So we have, if you draw this type of risk in this way, part of the questions we have answered. The other part, it says what components should consist of an integrated risk management. So in this space, IRM is integrated risk management. This is a risk management process, but IRM is integrated, means we combine all the risk types together and we manage with a framework issued by the Central Bank of Sri Lanka. And this framework we discussed in great details, and I think I supplied you direction issued by the Central Bank, direction number 7 of 2011 was the direction number. In that, we have discussed about IRM and what components should IRM. We said major components are these procedures and structure. We said this is the framework consists of.
So we can't see the board.
Okay, then I'll have to erase the middle one. Hopefully you have already done it. And I'll bring back this IRM into the middle of the board, right? Because the video is being set. The focus is on the board onto this side. So I will write again. Hopefully you can see now. IRM framework includes policies, procedures, and structure. So you have answered part of this, but I would like you to elaborate little what are these. You remember we discussed about policies. We had a whole list of policies. If you can give some example like integrated risk management policy, credit policy, credit risk policy rather, and market risk policy. You can go and list various policies. We had liquidity risk management policy, assets and liability management policy, then information risk policy. So whole heap of policies we discuss in our sessions. If you can give about 5 examples, you are going to little bit elaborate on the policies. Now procedure. We also said, how do you manage risk? You need to be documented, and these documents will go to all the staff, and based on that, they will do their day-to-day business transactions. So we have a procedure manual. And we have operational procedure manual. So on, we have various manuals describing the type of way how we engage in our day-to-day business. Then structure. I drew up something called 3 lines of defense. Three lines of defense, we include the business, and audit. Then we will go to CEO reporting. This we said you report to BIRMC, that is Board Risk Management Subcommittee, and auditors also we go to Audit Committee. Finally, we will have Board of Directors. This you can turn the other way. You can go upside down, or you can go bottom up. Put in the business unit first, and then the executives, then the CEO. Risk management, you can put operational risk management, market risk management, then you can put CRO, then you can have some executive committees, then go to BIRMC, thereafter the board. Audit, you can put internal auditors, external auditors, then they report to board. Audit committee. So if you put even of this nature or draw up a diagram out of this, you have answered. So IRM framework includes policies, procedure, and structure. Structure is this, procedures are here, policies are there, you have answered the question. So that's a very, very easy question because it is based on two sections we covered. Two sections are, we gave an introduction and then the integrated risk management of the second section. So the first question is based on two parts of our syllabus, and first one is very direct, and the second one you need to think a little bit of what are the risk types, and then also the other components. Components are policies, procedure, and manual. So I hopefully you have got 20 marks out of this, and if you in this format itself, even quite sufficient, because then I know your understanding is right. So with that, we'll move on to the second one. Here you need to do a little bit of reading. As CRO, CRO is your Chief Risk Officer of the bank. You have been invited to attend a corporate management meeting in which main agenda item is to initiate a strategic plan for the bank. You know, in banks we have so many meetings, and corporate management is where your senior management meet. And in that, they were making plans to have a strategic plan. That means strategic plan is a plan along with the budget they will make for little longer period, 3 to 5 years, what results we should achieve and how we should achieve those results, and what our key performance indicators how we should grow will be discussed here. Few technical adjustments will give you a little time because there had been inquiries about board cannot be seen properly. So I think the adjustments have been done. We are going to go into a little bit of darkness, and I have the light from the sunlight from one window, and this area will be darkened. I hope you can see it now. Right, thank you, Karin. All at the Lavand ahead of the ඇතිනේ එළිය. මට එළිය ඇති. මෙතන කරුවල කළොත් හොඳයි. එතකොට ඒකට පේනවනේ. So we are going to the second question. Second question is, I told you it's a CRO. CRO, you have been promoted to become the Chief Risk Officer. So Chief Risk Officer should know a lot of stuff, and all what you have learned so far is good enough to you to become a Chief Risk Officer. And now you have been asked to join a meeting. And that meeting, they are going to talk about a strategic plan and initiate various actions required to get this strategic plan going. So it is proposed that following action items to be implemented in the first year. They say funding of a large infrastructure project by way of a fixed interest rate over 15 years. Now, one of the person who is corporate management come and say, we intend to involve in a large infrastructure project, meaning there may be road development or building of a bridge. It could be of similar nature. You need massive amount of funding so what you need to understand it will be a large loan. And they say it will be given on fixed interest rate, and the period for that particular loan is 15 years repayment. So it's a long-term, large funding facility given for infrastructure. That means to build a roadway or to give a lot of facilities for the people to enjoy roadway or bridge or construction of a lake, or it could be anything of that nature which need long term to complete. At the same time, they are asking 15 years of repayment. So first of all, don't try to answer from here. Read the rest of the things also. Second one is introduce several new products to counter threats from the competitor. Now we have on the board the strategic risks now. So this is strategic plan. Strategic plans means you decide your clientele. You also how do you compete with your competitors also will be. So first one is you make a decision to select a client who involved in infrastructure project, and that person need large amount of money, and also is proposing to pay in 15 years. The second one, introduce new products. Now in banks, we know we have certain branded products. We have very standard products like current account, savings account, fixed deposits. Apart from that, we have minor savings, we have special loan schemes. So those are different products we could come up with, but within the same framework of either deposits or loans. So between them, we can have a lot of subsections and create certain brands with new products. So introduce several new products to counter threats from competitors. So competitor banks and telecom companies that provide several traditional banking activities. Now here I am bringing not only banks. This particular bank thinks the telecom companies, they are offering money transfer services, easy cash and so on. I have become a real competitor for the bank, and now you are bringing products to actually try and attack these competitors and win back your market share. So you are asked to comment on this. First read this. Then to outsource certain banking activities currently carried out by bank employees to third-party company in which one of the directors have interest. Now again here, you have gone to corporate management account, and one of the corporate managers says, one of our directors have a company, and he's willing to undertake some of the businesses currently carried out by the bank employees by his company. So you need to outsource that particular services to that company, and they will run for you. You don't need to have staff. Um, will you excuse me? Hello, hello. So third one is outsourcing activity of the bank. Now, you, since you are the chief risk officer, what they're asking is under these three instances, please identify the risk involved in each action items and make your recommendation to mitigate same. So you are not only asked, you have not been only asked to identify the risk involved in, but what you could do to avoid those risks and to take calculated decisions in order to enhance your um, profitability. So as a chief risk officer, now you are attending this meeting, and we'll take one by one of these situations, and we'll answer in such a way that uh, identify the risk. So question what they're asking is identify the risk involved in each of these situations and above action items and make your recommendation to mitigate. So not only they're asking you to identify, but asking your recommendation to, to overcome those risks. So I may need to erase what we have done in the first question, because this board need to be written in type of little bit of big handwriting, and so let me erase the earlier one. Hopefully you may have already write down this answer to the first question. Funding of a large infrastructure project. So it's a credit facility. It says large. So you have one risk. If one of the large customers of your bank, if he's fall into non-performing category, you have credit risk. Especially they say it's repayment is over 15 years. So we also have under subsection, we have a term risk. When you say it's a long period, there is possibility they might fail over a period. If you give a loan for someone to import and provide a revolving import loans, goods come within 3 months, you will recover your money. But if you give a long-term repayment, there are occasions that at this 15-year period, there could be change of environment, change of macro conditions may allow this particular client to fail in business. If he fails, you have credit risk, but risk come from for a long period you have given. Otherwise, if it is a short period, you would have recovered your money. So this is one of the risk what we have identified. It also says project has to be given under fixed interest rate. I put down the second one as interest rate risk because in the markets interest rate fluctuates and it could fluctuate in shorter period also, and here we are talking about a 15-year period, and at the time we'll say you granted this facility, the interest rate is at 10%, and Central Bank of Sri Lanka thinks we should bring down interest rate, so they decide the policy rates to cut policy rates and bring to, we'll say, 8.5. So what happened is now you have a facility which customer pays you 10 and current market rate is 8.5. What happened is you have a free flow of income of 1.5% over next 15 years. So which is a very good thing because you have granted this facility at a very high interest rate, and when the market reduces, still you enjoy because you have signed a fixed interest rate contract. However, this fixed interest rate, customer might come and make appeal to revoke that, but as far as this question is concerned, it says proposal is to get this customer on a fixed interest rate. So if interest rate goes up, if the country's inflation goes up, and naturally the interest rate will rise. And if interest rate rises, you can't jack up your interest rate what you have given to this client under the contract. So you will be still charging 10%, whilst we'll say the current market rate is 12%. So you tend to lose 2% over very long period, which will be interest rate risk. So when you contract something on a fixed interest rate, there is always interest rate risk because in the market interest rate fluctuates. So what we have identified is only these two risks involved in this, and credit risk and the interest rate risk. And under credit risk, we say major portion come from, it's a term risk, and because of the period is very long. And also says large infrastructure project means it's a large customer, and if you face NPA is naturally going to have a very impact on your risk management. So we go on to the second one, introduce several new products to counter threat from competitor banks and telecom companies that provide several traditional banking activities. Now, here we said customers and competitors are the main question. So the second one, they are talking about new product development. This product need to be very attractive to your customers, and it should beat all the products what is in the market put by your competitors. So naturally the risk type is strategic risk. When you do strategic risk, you can talk about various theories like SWOT analysis, Michael Porter's competitive advantage. All those you can mention here because strategic risk management has to be done with those models. So if you put SWOT competitive advantage, and then if you have done this as mitigation techniques before you develop a new product. Now I didn't say about the risk type. Now in this question they also ask mitigation, recommendation for mitigation. Interest rate, when you say fixed term, you always have a problem. So you can suggest fixed for certain period, say 5 years, and thereafter floating. Term risk you cannot reduce because he's asking 15 years, especially if you give, so you need to calculate internal rate of return in your evaluation. If the project is going to be completed, could be completed in 5 years, and still the customer wants 15 years repayment, then you should be able to reduce that because in 5 years he will achieve all his objectives. So you need in your evaluation, the mitigation techniques is proper evaluation to see the duration, and also to have a fixed term interest rate for going for some period and thereafter floating. That is mitigation. Second one is the strategic new product development. Strategic risk, you need to do some kind of SWOT analysis and also consider competitive advantage like Michael Porter did, whether your products will be subject to threat from within the industry, that is other banks can imitate this, or any substitute product will come, or your suppliers and customers will get attracted to this, or the fear of being able to sell the product to them would also be discussed. So especially what we need is about strategic risk. If you mention that the mitigation technique as SWOT analysis and competitive advantage analysis, I would give full marks. The third one here is to outsource certain banking activities currently carried out the bank employees to third-party company in which one of the directors have interest. Now, what is the risk here? That one is about outsourcing. You all know in business now, what we are not really good at it, but if we have a certain company which can do better than us at a very low cost than what will be incurred, because generally bank employees are highly paid staff, you can outsource an activity and give that to somebody and pay a low amount. Bank would like to do that because then bank can make more money. And but here, what is the risk? Central Bank has issued a guideline on what type of services we could outsource. Here, then the risk is, are we adhering to those guidelines? Risk is compliance. So we need to see the activity what we outsource is not subject to restriction by the EBSL. We need to check that before we outsource that activity. There's another portion of it. They say this particular company is third-party company in which one of the directors have interest. So now you remember, here we have another. It's called related party transaction. And related party is one of your directors that's come under corporate governance. Hope you can see. So we have another risk is called lending to your, allowing the third party to perform a transaction of the bank, then he become a related party. There are certain rules given under the Corporate Governance Act, and we need to see that we adhere to those terms what is mentioned in the corporate governance. If you give an answer like this, you have covered all three sections. So you have identified the risk. So you need to mention the type of risk you identified. Credit risk. If you go a little further and say it's a term risk, I would give maximum points. Then we also, the first one carried 15-year term with under fixed interest rate, and fixed interest rate have always risk of the interest rate risk. And you need to mention some solutions to that, which I said you can give it for certain period of fixed rate. To avoid credit risk, you need to have a good evaluation. Introduce several new products is strategic risk. And we said you can mitigate through SWOT and competitor analysis. To outsource certain banking activities currently carried out by bank employees with third parties, it's a compliance risk, and also partly the corporate governance. We also discussed these two activities in details in our lectures. So you have got 40 marks, and it didn't take that long. So probably you can spend a little more time in elaborating what I have mentioned in order to complete these two test papers. I will go a little faster than this for you to understand the risk, the questions. So now we move on to the third question. It's a very simple one, I believe. Central Bank of Sri Lanka has directed all licensed commercial banks to fully implement the requirement of Basel III Accord by the year 2019. State the main features of Accord and how it contributes to the financial stability. So this question is about a roadmap. I posed this question in 2018 because in 2019 the roadmap was to complete the Basel III requirements by all commercial banks, and I think most of the banks have achieved it, and during the time specified. And we want to know what is Basel. We had 1, 2, 3. I don't want you to mention about, here they are especially asking Basel III. Some of the answers I got was not up to the standard in this question. Most of the candidates who tried these questions, they spend a lot of time explaining to me what is Basel 1, what is Basel 2, the three pillars involved in the Basel 2, and finally forgot what are the main features of Basel 3. Basel 3, can I go ahead and erase my answer to question number 2? Hopefully you may have written down, or I can give another, say, 3 minutes while I enjoy another sip of water. Right. So now I'm going to erase the second question on the board. I don't have the exact notes of what is Basel 3. All Basel Accords is uh, to strengthen all Basel Accords. Our main objective is to strengthen the financial stability of the country. So I think Basel 3 also in the same line after Basel 2. So what we need to mention is what we have covered under Basel 1 and 2. Basel 1, we only covered the credit risk of the bank. Then we had this financial crisis. And before the financial crisis, the Basel 2 committee recommend to cover other two type of risk, which is credit risk, market risk, and liquidity risk. So you can mention this here, what is being covered. And since it covers only market risk, credit risk, and the operational risk, we discuss other type of risks which are not covered under this. So Basel 2 had the second pillar. And second pillar, you remember I was speaking about ICAP. ICAP is for bank to determine what is not covered under Basel 2, the first pillar, which is operational risk, market risk, and the credit risk, like liquidity risk, reputation risk, legal risk, your corporate government issues. All that should be decided, and you prepare a document that you are covered all that, and therefore central bank doesn't have to intervene and request you to provide additional support by way of equity to manage this risk. Then Basel 3 went on, Basel 2 went on further about market disclosure and banks to be transparent and accountable for what they do. So if you mention a little bit of that, what we are going to achieve in Basel Accords is the financial stability. So you can very slightly you can mention about 1 and 2, but I'm not asking anything in this question. I am asking Basel 3. Basel 3 has different purposes. Basel III is to actually enhance quality and quantity of capital. In Sri Lanka, our car under Basel II was 10%. Here they are asking over a period under Basel III we increased to 14%. 14% for banks which have over 500 billion asset base, others 12.5. So what they're asking here is enhance the quality and quantity of capital. Here they say high quality capital, especially tier 1 capital. So you don't have to, if you mention what is being asked by Basel II is to enhance quality of capital, and if you mention it is 10 to 14%, you have answered your question. It also said not only capital, they say manage liquidity with two new ratios. What are these two new ratios is the one I'm asking you. Liquidity cover ratio, which you can explain further. Under this, they say available high quality liquid assets for 30-day horizon divided by required high quality liquid assets for 30-day horizon will should be either equal or exceed 100% under this cover ratio. So but central banks required that these two new ratios need to be reported to the regulator on a certain period, the requirement what they have asked for. Generally, I think now on a monthly basis, banks give them these two ratios to the central bank to see that they manage liquidity with these two ratios. The second one is net stable funding ratio. Unfortunately, I can't ask this question from you to explain. What is this? If you have in a classroom, I could have got a lot of answers from you. It would have been make my life easy. But I will tell you, net stable funding ratio is stable funds divide by net cash outflows. I want to read that to you. I don't have it here, so we may have to go back to some of our lessons if we have to find this. Please refer my slide. The slide has exactly the definition I have given on this. So what we required here, the answer will be 2 ratios of liquidity and 1 quality and quantity of capital. If you mention this and mention the net stable funding ratio and the liquidity cover ratio, you have covered this question. And I may not be able to access my slides, so I want you to go back to your slides. Let me see whether I have some notes here. Notes will give the exact terminology what we use in describing this. Unfortunately, I think you will have to look into that. So with that we can go into the fourth question. So remember, these 2 ratios are important, and ratios you write down exactly the terminology I have used in computing these 2 ratios. Now the fourth one is fourth question. Is corporate banking unit has evaluated a credit facility. Now corporate banking generally what type of facilities they go for? Corporate customers. Corporate customers are companies with large capital, and we gave a definition. We said over 35 million credit line and over 600 million turnover. So corporate unit evaluate those type of clients. Requested made by a garment manufacturer. Now they also go and identify what type of business this client is. And it says to a single overseas buyer. This is a very common thing in Sri Lanka because our garment manufacturers, they produce one type of a garment, and that will be bought by one buyer in overseas. As recommended, facilities to tune of 100 million against intangible securities. So this is once again a credit area. A loan has been requested by a garment manufacturer. He's a corporate client, so he's a large type of a client. Here they have mentioned the industry what he is in is garment manufacturing or manufacturing, but for export market. And they have given us a little bit cautions by saying he's an overseas single buyer. That means he doesn't have a spread of buyers to sell his product, but he's probably would have contracted to finish those garments, and probably the contract may involve the overseas buyer will buy all the garments without any surplus so that he could export the entire production to one client. and recommend a facility to tune of 100 million. So they have already given the amount of money which he wants to borrow, and also the question now says he is not giving uh, tangible securities. Tangible securities you need to understand, like property mortgages, cash, guarantees, or treasury bills and bonds. The intangible securities include a corporate guarantee, that sort of thing, where you can't completely recover in case of a default immediately, because you can't go to courts and do repossessions and file actions against that. You need to file action against the document only. It's been signed by the directors. The appraisal form had been submitted for your approval. Now we said corporate banking units evaluate. We said in our credit management process and credit risk management process, original customer, we don't, risk managers don't deal with the customer, but business unit deal with the customer. They first, what they do is a item called loan origination. So they have got the all information. Second one, we said evaluation, and then they prepare a document called credit appraisal form. So appraisal form had been submitted for your approval. So now we are in the risk management unit. We have got this particular form which has all the evaluation notes of this client. He's asking 100 million. He's not offering tangible securities. He's in the garment industry, a manufacturing client, but also they have said that he's supplying to a single client. All those information are given. List out the risk faced by your counterparty that may hinder repayment. That means what it's asking, a client of this nature, what type of risk he faced. We discussed under it, the counterparty risk is a customer who defaults you, but he defaults because of some business failure. Business failures come from risk what he faces. And we also discussed the type of risk a client failed. So it is similar that he will face financial risk. To avoid that, what we do is we do a ratio analysis of all his profitability, his liquidity, his solvency. So we have now established major risk what he. So I will go back to the board, and I may have to erase this for your better viewing. So I will erase what I have put down on question number 3. So question number 4 is about, once again, it is about credit risk. Outline the risks faced by the counterparty that may hinder repayment. Now, under credit risk, we have collateral risk. Because he is not giving us tangible collateral. Then he also says he's doing exports. Exports will have this client will be sending to a different country, and if that country's authorities decided that no remittance will be sent until they approve it, and there are a lot of restrictions being imposed, then we call that sort of situation will be country risk, and your money will not come, the client will not come because of the country risk. Then we said single buyer. In order to give this facility, you also have a problem that is a single buyer. So your evaluation about your client should involve the collateral what is supplying, the country risk, which country is sending, buyer risk, we say you need. So you need to study about the country, you need to study about your buyer. So you could actually in your evaluation, you need to get status report of the buyer. So list out the risk faced by the counterparty that may hinder repayment. It's also is dealing in foreign exchange because the currency could get devalued based from country to country. So he will also face he may contract to sell his items, say we'll say $2, and if the dollar depreciates, he get less rupees when the money being remitted to Sri Lanka, but generally it happens the other way. However, it could face forex risk also. So if you have mentioned these 4 items, you have list out all in your appraisal what you need to be. What risk mitigation techniques you may use to minimize credit risk to this bank, to the bank. So we have listed out the credit risk. Collateral, in your evaluation, you could use some covenants. If he's offering only intangible collateral, so collateral is little weak, but you could insist some covenants. Covenants, we said financial or non-financial, which could include certain conditions that if you have analyzed his balance sheet and if you decide that he should not declare any profits to his directors or shareholders, you could actually say dividends cannot be paid without the bank's permission. So you restrict money moving out of the company. So you cover yourself. Then he also said price. If the client is not providing collateral to the liking of the bank, banks are generally charged a little more to cover that risk through a high interest rate risk. High interest rate on the your approval. So if the collateral is not coming forward, you can use covenants and price to mitigate risk. Country risk, you need to get report again about the country report and to see the stability of the government in that country and how the business are moving. So you can get some kind of a knowledge to avoid these countries. Buyer risk, I said to all for status report. Status report, I also mentioned there's a company called London Street. They provide international reports of clients when they deal in international transactions. Forex risk. We also discuss under market risk certain mitigation techniques called If he thinks when the money comes, the currency which he deal with this particular country get depreciate against rupee, so he could say, I'm planning to get, say, $1 million. Can you give me a forward rate to get the same value on this? So the banks will provide, when the exposed proceeds come, it will apply that particular rate for these transactions. So number 4 question is very easy, because you can see it is credit risk. But here we have already mentioned in the question itself, it is to do with securities, and it says it's a corporate client. So in his appraisal, we need to see that the risk he faced, financial risk, he faced the country risk of that bank, that particular country where his buyer is, that he faced the buyer risk, for which you can take a status report. He faced forex risk because of the currency deals, for which you can do a forward booking. So if you can answer in this fashion, it's very easy. You need to elaborate a little bit on this, what I have already speaking of. But even if you have put like this, I know that you have understood the question and the answers are sufficient. But in a theory question of this nature, you may need to write a little bit of it, what you do. But on the board, I have only outlined the salient points in which you should get your answer into the script of your answer script. So with that, I think we have covered 4 questions. We'll move on to number 5. So we'll see that we can finish at least 2 papers today. Newspaper article on business outlook on the construction industry in Sri Lanka predict possible burst of bubble of condominium apartments in the city of Colombo. Your bank has credit exposure to 25% of total loans granted to this sector, which amounts to rupees 50 billion. All these loans are rated BB and 50% on clean basis. Economics predict all BB rated loans given to build condominium apartments will be downgraded to substandard category. Based on above, conduct a stress test to arrive at the impact of your bank's profitability. Year-to-date profits are 1.5 billion. Now, this is a kind of an arithmetic question, and also giving you an idea about certain tests what we do to manage risk. Certain measurements what we do to manage risk is being tested here. I'll need to go back to board. You need to read this question once more. Newspaper article on business outlook on the construction industry in Sri Lanka predict possible burst of condominium apartments in the city of Colombo. So the news item or the scenario to do a stress test is to say construction industry, a bubble might burst. That means we have put a lot of money on this particular type of segment of the industry, and industry is construction, but there's a segment of condominium apartments, and there's a problem there. Your bank has credit of exposure 20% of total loans granted to sector, which amounts to 50 billion. So they say your exposure to construction industry is 50 billion. So we go into the arithmetic of side is, so when 25% means you need to understand your total loans. Is 200 billion. based on information what I have got, 25% constructions is 25% of this, which is 50 billion. So we are building a scenario. Scenario is that this particular sector is vulnerable. All these loans are double B rated. So we have rating here. Double B. Now we need to immediately understand when it says double B, double B risk weight given is 100%. And it also says 50% of this is 50% of this, which is 25 billion, is clean. So you don't have collateral to cover this particular amount. Economics predict all double B rated loans given to build condominium apartments will be downgraded to substandard category. Now you need to understand the categories what we discussed when loan don't perform. Your non-performing advances between 3 months to 6 months, or 90 days to 180 days, we call it special mention. Second category is from 180 days, 90 to 180. 180 to 360 is called, that's the category what they have given here, downgraded to substandard. So immediately you should know there are two components where the NPA goes. Interest in suspense and the provisions. In substandard category, yes, you need to suspend interest and you need to provide 20% provision of the NPA. Now, they are asking you to, they say, based on above, condominium apartments will downgrade to substandard category. Based on above, you need to stress test to arrive at the impact of the bank's profitability. Now, 20% of 25 billion will be, you need to make provisions. 20% of 25 billion, which is given on clean, will affect your bank's profitability. So that amount is 5 billion. So you need to immediately debit your profit and loss account and debit your profit and loss account and credit the provision account. So 20% of provision on this clean loan will be 5 billion. And they say your bank's profitability at the moment is 1.5. And you are going to make the provision of this. Another 5 billion is going to hit your this 1.5. What happens? You will have a 3.5 billion loss. It has not happened. You have made only provision. So this is the situation when you have about this nature of a disaster, where all condominiums, if you are given on clean basis, and if there's a bubble has been burst, there's a huge loss, and that loss is amounting to 3.5 billion, and your bank has, up to that year date when this happened, has made only 1.5 billion, and you will have a risk of 3.5 billion. Probably you might sell some of these and recover, but as per stress test, since if it is clean, our calculation will go on the basis of substandard category, which is 20%, and 20% of 25 billion, 50% of loans are on clean basis will come into that category, and you will have a 3.5 billion net loss when this disaster occurs. So disaster has not occurred. That's why the stress is given. Economics.
Excuse me.
Yeah.
Can you please explain it again, sir, from the beginning?
Yeah. Okay. You have a loan portfolio of 200. That was I calculated based on. They say you have a 25% loan granted to sector amounted to 50 billion. That means 50 billion, if you expand it to 100%, will be 200. 25%, 15 to 4 times will make 100, because we said exposure to this sector is 25. Then it says from 50 billion, further 50% are on clean basis. So I got 50% of 50 billion, which is amount to 25 billion. Now, when this bubble burst, they say, economics predicts, this has not happened. In a stress test, what we do is actually prediction of the future. So when the economist says this sector might fall and a crisis will occur, so risk managers generally do a calculation, and that calculation is based on the scenario. So we'll see the scenario here build up is, you have a 25 billion at stake in the construction industry, which is given to condominium apartments. So 25 billion will be subject to 20% provisioning based on the category which is in. Substandard category, we say the other two categories I go 360 to 540. These are called doubtful, and over 18 months, over 540 days is called loss. Now here they say economists doesn't predict this will go into this level. The moment the crisis occurs, it will move on to substandard category. Substandard category provisioning is done 20% of your exposure. Exposure which is clean. That is, exposure I mean is it is not covered by collateral. So clean portion is 25 billion. 20% of 25 billion is 5 billion. So if a crisis of this nature happen, bank will have an immediate impact of 5 billion loss. It says year-to-date profit. At the moment when if this happens, you have already made 1.5 billion profits. So if you have a 5 billion loss, the net effect will be 3.5 billion loss. I hope you understand now.
Yes, sir.
Yeah, thank you. So we have covered the fifth question also. We'll move a little faster to our sixth question. Right. The sixth question, in order to provide maximum convenience to customers, now banks use several channels to deliver their products. The result of multi-channel delivery of products lead to enhanced operational cost and risk. State the different categories of operation risk and how would you propose to mitigate high impact, low probability events that may cause operational loss to the bank. While I go to the board, I think you need to read once again this question. Remember, you have answered 5 questions, so exam is over now. But we have covered about less than 2 hours. I don't want you to go from the examination room within 2 hours. I want you to use your entire 3-hour period given to you to write your answers. So little read through, even if you have done by this time, if you have finished. But I don't want to take the same sequence what we have went through, but you can select the questions by allowing yourself to read the questions for about 15 minutes before you tackle the question. So we'll take the question number 6. In order to provide maximum convenience to customers, now bank provide channels to deliver their products. Now, you know, I mentioned the delivery channels. I said brick and mortar. I also said ATM, phone, and internet. So these are the delivery channels. Now you are building your case. Multi-channel delivery products lead to enhanced operational cost and risk. By doing this, we may subject to operational risk. At this point, you need to give a kind of a different definition to operational risk. I don't exactly remember the definition which I gave you. It is mainly losses arising from failure or inability of processes, people, and events. Events could be internal or external. So you can read the exact definition what I gave you. So this is the nutshell. We have a brick and mortar operation, ATM. Brick and mortar is your branch banking, ATM, phone and internet are the channels.
Sir,
But-
first two lines unable to read.
Pardon?
First two lines we unable to read.
Delivery channels is the top line. Second line is called the channels what you use. I wrote as brick and mortar. I'll rewrite again. Second line is brick and mortar, ATM, phone and internet. Then you need to give the risk type here is operational risk they have already mentioned. So you need to give a little bit of definition. Operation risk is inability or failure of your processes, your people, and certain events, internal or external events that could occur to your day-to-day operations, which will result in losses. So this is, you need, so far you have built up. State the different categories of operation risk and how would you propose to mitigate high impact, low probability events that may cause operational loss to the bank. Now here, you are providing these type of services. You are providing branch banking. Branch banking involves people. People can do mistakes. So the type of our operation is brick and mortar, and the risk is relating to people. Here I would ask you to propose different categories of operational risk. Now, I gave a chart, which I cannot exactly remember myself to write all that. In that chart, from this side, I wrote execution and delivery. If you are into brick and mortar operation, your staff will have to execute many transactions and deliver to customers. So the major risk come from the delivery categories, execution and delivery. I need to get that complete. There are 7 categories. In this situation, major portion of mistakes of relating to your processes and people could occur from execution and delivery. Then the events will cover any external or internal. Brick and mortar, you will have a bank robbery or fire, lightning, or any external event which occur losses will include events. So those events are external events could be detrimental to your operations. It could occur from natural sources or man-made situations, and if you happen to get subject to any of those events, you will have operation risk. So I want you to go back and read this particular slide which I command operation risk. When I conducted the operation risk, I put these 7 categories. 7 categories. The main category here is the execution and delivery, but for you to give an answer to these questions, you need to actually probably to state all those 7 categories, because it says state the different categories of operation risk and how do you propose to mitigate. Now, mitigate the low impact, high impact, low probability events. Now here they are not asking you to mention about how do you mitigate all the risk. They are asking only one type of risk, for which I will draw a famous diagram. We'll say this is impact, this is frequency, we said low, medium and high, low, medium and high. And here the question says, how do you propose to mitigate high impact? So it is in this line, low probability. So it is somewhere here. So event that could occur here, they're asking how do you mitigate. Now I can give an example. First you have to remember, high impact means your loss is great. Amount of money what bank is going to lose and operational risk is very high under this event is occurred. But it won't occur on a day-to-day basis. Once in a blue moon it happens. So here they're asking if that sort of event, how you categorize. We'll say high impact could be a major robbery of your cash van. It doesn't happen every day because you have taken a lot of precautions. How do you occur? How do you mitigate? I have given you how do you mitigate this sort of events. We say we transfer the risk. How do you transfer the risk is you generally take a insurance cover. So these things you cannot control through your internal controls, but you have already applied to mitigate other operation risks. So you need to transfer risk. So what we mentioned is high impact, low probability events need to be transferred to a third party, and you do that by way of a insurance cover. So to answer this question incomplete, you need to actually mention the 7 categories of operation risk which I have mentioned in the slide, and also to give this chart and draw where the high impact event could occur and show it is less frequent happens, and then you have to mention that it could be covered under transfer risk by way of taking an insurance cover. I think we need to take a break, and we'll get back at 11 o'clock to tackle the rest of the questions. With this, I think you should be able to, most of the questions had covered different type of risk. We have covered operation risk, we have covered credit risk, we have covered the initial introduction and integrated risk management here. So when you have about 5-6 sections of risk management, and if you have completely studied at least 5, you should be able to answer 5 questions or even more with that knowledge. So, but my understanding is that you need to cover the entire course, and then therefore you need to know all risk management sessions what you have carried out, and as a result you should be able to understand the whole thing. So when we come back, we will do this computation of once again. I have done some arithmetic here for you to answer very easily, and you need to use a calculator, so don't forget to bring your own calculator when you come to this, because if they don't allow you to use your phone, you need to have a calculator. So number 7 and 8 will come after, and we'll do the justice to the number 7 and 8. Right. Now we are on the 7th question, and it's a very easy one. 20 marks are up for grab in small calculation. This is relating to compute the impact of current profitability of 750 million of your bank if they are given 2 scenarios. If these scenarios occurs, and what will happen to your current profitability is the question. So the first scenario, they say carrying a short position of foreign exchange of 1.5 million if exchange rate fluctuates from today from 168 to 172. Now you need to understand this is relating to market risk. One of the component of market risk is foreign exchange risk. Foreign exchange is required for banks to carry out various functions. We have nostro vostro accounts, all those taken care of, and we end of the day we convert all those currencies into US dollar mid then arrive at the US dollar position of the bank. Now this position, it can be either credit or debit. If it is credit, that means we hold our money at various bank accounts and our total is in credit, that means we are having a long position, we say. And if that balance is in debit, that we owe that amount of money, and that amount of money is a short position. Now here this scenario is a short position, that means bank has borrowed money in foreign currencies from various other counterparties, and as a result, at the end of the day, today we have a 1.5 million exchange rate, 1.5 million US dollars we owe to other banks, and so today's rate is 168. So what we need to do is do a calculation to arrive at our short position is, we indicate 1.5 million USD. I would say I put this amount in brackets because it is short. And the current exchange rate is 168. It's in the rupee. So our balance sheet will have 1.5 times of 168, which is 252 million in rupees. This is the rate. This is the rupee. Now it says our profit right now of the bank is equal to 750 million. And it says it may change to 172. So if you have 1.5 million, so this will be a debit balance because we are having a short position. And the rate is 172. And then if you 172 into 1.5, it will be 258 million. So rupee has depreciated, dollar has appreciated as a result from one. Now we have to pay for each dollar 4 rupees more. And as a result, we are having a higher debit balance in our accounts, in our balance sheet. So higher debit balance means the difference of this is 6 million rupees. We call it forex loss. So we have a 6 million loss. I put them under brackets, and as a result, now our profitability will be 744. So you have answered very easily the first part of the question and gained 10 marks. Second part, you need time to look at the computation, how I did. You need to understand whether position is short means it's a debit balance. And when you have a short position, if exchange rates increase.
The board is not clear.
Board is not clear?
Yeah.
Which line?
Every line is not clear.
Huh? Any line is not clear.
Yeah.
Now, I'll tell you how do you calculate. We have 1.5 million short position. You multiple 1.5 million into 168. Then you get 252 million. That is the amount we owe to other banks. So in your balance sheet, we have a debit balance of 252 million. And exchange rate fluctuates from 168 to 172. So you multiple 172 into 1.5, you get a figure of 258 million. So your debit balance will increase from 252 million to 258 million. The difference between these two figures is your loss on forex, which is 6 million. That you deduct from your original current profitability, which is 750 million. So you get the result of 744. Is it clear? I'll go into the second question. Second question also related to market risk. Market risk is either interest rate risk, forex risk, equity risk, or commodity risk. Now here they call it a equity. They say actually this particular question was corrected subsequently before it went for the test. I think I have got the uncorrected paper on this. Drop of 5% of banks' equity portfolio is of 500 million purchased a year ago. Note that the present market value is 510 million. So please correct that. Bank equity means they invested stocks or shares Originally 500 million was invested. Now today the market value is 510 million. And in the meantime, bank also has got, now already we have a profit of 10 million here. Bank also has got dividends during this period, another 100,000. And they say here, there's a drop of 5% in the bank equity. Now the 510 million is the market value. When there's a drop, means market has collapsed by 5%. So 5% of 510 you have to compute. I think it is 25.5 million. So today, the value of shares what we have is 500 less 510 less 25.5. So you need to compute what in this figure is. That is so now your market value is 484.5. So what is the difference here you have lost? You have lost 15.5 as a result of 5% equity values have gone down. But in the meantime, they say you have made a profit of, so this is a loss. So you have to minus 100,000 is 0.5. The actual loss is 15.4. And our profitability is 750 million, out of which now we have lost 15.4. So this has dropped to Is the board clear? You invest 500 million on shares. At a particular given date, you see the market value. That means you looked at the share price, what is mentioned in the papers, and you multiple that shares with the number of shares you have. Then you get a price, you get an amount of 510 million. That means from your investment, You have made now 10 million rupees. We call it capital gain. But our scenario says suddenly there is a 5% drop in all shares. And 5% drop means 510 into 5% is amounting to 25.5 million. And you have to deduct from your current market price to arrive at your present price after the drop. So it amounts to 484. Your original investment is 500 and you reduce 484.5. That means 15.5 million you have lost because of this 5% drop. They also say during this time you have also received dividend, which also have gone into profit. So though you have made loss of 5.5, you need to actually deduct that original income you got by way of dividends, because already that money has come in. So the loss has reduced to 15.4. And your current profitability is 750. Now, because of this scenario, you have lost 15.4. So you deduct 750 from 750, 15.4. Answer is 734.6. So these are the type of questions you get in market risk, because we say it is very straightforward. It's a price risk. So price risks include kind of calculations like this nature. You need to understand when it is foreign exchange, whether your position is short or long, and in equity, what's the amount of you need to understand terms like what is your original investment. When you say market share, market value is current price of the shares what you have originally invested, and any drop in that will be a percentage of current price, and so on that basis we have computed. We only in shares we get capital gain plus dividend. So here there's a particular portion of dividend which have been received, which have been gone into profit. So though you have make a loss of 5%, it amounts to 15.5. You need to reduce already gain amount of 100,000, and as a result, the total loss come to 15.4. That you have to deduct from your current profitability of the bank to arrive at the position, and we have done that. As a result, your profitability in the bank ENL account now will show 734.6. So those are very easy, and we move on to question number 8. The question number 8 is relating to a sections we covered under corporate governance, and I think that was the last sessions we had, and so we are tackling the last question also. As per the corporate governance direction issued by the Central Bank of Sri Lanka, bank establishes several board committees to manage the affairs of the bank. Name the board subcommittees of your bank and describe the objective and functionality. So it's a theoretical question. You need to study your corporate governance notes to answer this. So shall I erase our computation? Actually, I went to write your answer on the board. I'm not the one who is going to write on those answer scripts, so which you need to understand. Basics, what I expect out of this question is for you to remember at least the both subcommittees which are under the corporate governance. Mainly BIRMC is the Board Integrated Risk Management Committee, which deal with the risk management, and our subject matter is risk management. But also linked to that, board is interested in managing the assets and liability of the bank, which also a very important function. Now, risk management, the objective and functionalities, you need to understand that you need to mention objective is to that we will have no surprises, that all the risk types in the banks are managed so that losses can be minimized. The functionalities attached to the risk management unit, which has a section of credit, market, operational, and IT to look after various risk types. Then come to assets and liabilities. It is the function of treasury, your finance department, and the risk management, all three to combine, because all of them have a stake in this particular subcommittee, because treasury deals with various rate changes, finance deal with the performance of the bank, and also the computational liquidity, and then risk management also can contribute to manage various risks involved in assets and liabilities, the interest rates, and so on. So objective is on the ALCO, it's vivid. It is managing liquidity and also performance, and also part of risk management. So liquidity means liquidity management come under risk management also. Audit will include internal and external auditors to see that through audit only you can actually lessons learned for risk management will be learned through audit objectives. So generally this committee also deal with various operational losses. Those operation losses from the operations department get informed to the risk management, and as a result we will know the lessons learned, or the loss data will be collected and stored for future internal controls. Finally, I go to remuneration and nomination. Remuneration is about salaries and nomination is about your promotions. The board also interested in getting the right HR function going in the bank, so the right people will provide right direction and improve efficiency of the bank, and the board is interested in putting the correct people on the correct functionalities and give them the correct authority to function in their functions. As a result, they can achieve results of profitability, and that's what the banks are for. So question 8 deals with, you need to mention these subcommittees. Objectives I explained to you, and these are theoretical questions which you need to study and write about the subcommittees, write about their objectives, write about their functionalities, and probably you will get the marks. Some may be good at calculations. Calculations are, if you made it correct, you get the highest points, because theoretical questions you may By memory, you may not be able to cover. Even my memory, at my age, I don't think I have that amount. Because I didn't study these questions, I only taught you with my experience. I told you how to answer these, and preparation of examination is even little more complicated than that. You can have knowledge, but you need to fresh yourself, brush yourself with current reading and memorize those in order to answer questions. So to avoid most of those memory losses, we put in between here there are two questions with computation, and those computations, if you handle it logically, you will get the total marks allocated to that question. With that, I think today I'm going to wind up. Yeah. Any questions?
Sir, sir, yes, sir. So if we go to question 7, part 1 again, what will happen to the profit if that rupee is
Yeah,
appreciating?
then it is the other way about it. If rupees appreciating means, we'll say you have a 168, no, that day's rate. We'll say rupee appreciate, and if the rate is 166, if rupee appreciate, amount of rupees what you're going to pay for dollar get reduced. You understand
Okay.
that, right?
Yes.
So we'll take assumption rupee appreciate and the exchange rate drop to 166, right? So 166 into 1.5, can you give me the answer? If you have a calculator.
$753 profit.
700
53 profit, I believe.
so you have 255. One point. I'm looking at the profit coming out of.
3 million.
Yeah, then it becomes 249, right? You have 249 million. Is earlier you have a 252, so you have a profit of 3 million, and 3 million plus 750 million already there, so your amount is 753, right? So if rupee get appreciate when you have a short position, you will not have a loss, you will have profit. So profit will get added to the current profit. So in this case, if dollar goes to 166, bank will gain 3 million, and as a result, your profitability will go up to 753. Understood?
Yes, sir. Thank you very much.
Yeah. Next week, actually, I stopped right now. The reason is we got an opportunity to meet each other and discuss the next paper. And next class will be a physical class where you could attend, and we will have the next paper. Probably I want you to read and come. So we will work out this way, and then we can actually discuss and work out nicely. So that's what I thought. The next paper, which is 2019 one, which is the most recent one, will be discussed in class, and date is 27th. So it says bankers are risk managers. Numerous risks they required. Also here, similar to our first question, numerous risk means numerous risk type. We need to understand what type of risk banks take. what is the board of directors' involvement here? It is integrated risk management. So the question is actually similar to what is in 2018. You need to read and come. Similarly, I would like you to read the whole question paper and come. So we could discuss. The second one is a counterparty risk one. Again, there are 3 scenarios. So if you read, there are 3 scenarios from different industries. And third one is about, again, a scenario based on the economic and political front. Its exposure to tourism will be discussed. So this time, I think definitely I may have to touch COVID-19 epidemic, similar situation, what will happen. So still I have not done the question paper yet. So probably all what I said during the past, third question will be in this paper. It is about the macro conditions. So I have a lot of facts to draft another macroeconomic condition question based on the epidemic we had. The fourth one, it's about again the delivery channels, it's operational risk. The fifth one is investment portfolio, which relate to market risk. Question 6 again, it's about Basel III. 7, it's about compliance. And third one, last one was corporate governance. So it is at a similar pattern of what we have discussed. I would like you to read these questions carefully and come. And based on that, we could develop a good understanding what's going to happen in 2020. When the paper comes, I hope you will be able to tackle with this approach where we generally won't discuss into this length of past papers. I could give hints, but now today we did the complete paper. I put a lot of calculations and points on each questions on the board. I want at least that level of answers, because some people write theories, some people don't even give the right points. So at least right points should be there, then I will understand that you understood the question and you are on the right track. With that, I will conclude today's session and hope to meet you at 8:30 on the 27th. And it's a physical class, like what we had last occasion, where we met each other, and then more dialogue could happen provided you read and understood the questions and come and ask, put me on the focus so I could explain further. Thank you very much.